Welcome to this explainer. Okay, so if you're like me and you're chasing that coveted A star in IGCSE Accounting 0452, we absolutely need a flawless strategy. Today, we're going to completely deconstruct the club's receipts and payments module. This isn't just about surviving the exam, It's about mastering the 2026 syllabus updates so we can both walk into that hall totally confident. Okay, let's dive into this ultimate study roadmap. First, the A star blueprint. Then, mastering the T account logic. After that, we'll hit the prudence concept pitfalls, followed by evaluating liquidity and ratios. Finally, we'll look at AI accounting in reality and wrap up with examiners' do's and don'ts. Section 1. The A star blueprint, focusing on fundamentals and terminology. Now, I realized something super important recently. Cambridge transitioned to modern international terminology for the 2026 syllabus. You guys, this means using outdated terms will literally cost us marks. It's a simple fix, but absolutely crucial. Words like bad debts, they are completely out. We have to use irrecoverable debts. And instead of just saying capital, we really need to be precise and write owner's equity. Nailing this right out of the gate shows the examiner that our knowledge is 100% current. Let's talk about exam pressure for a second. Under intense pressure, sometimes my mind just goes completely blank. To prevent that panic, I locked in the core accounting equation with a super simple mnemonic, ALE. That's assets equals liabilities plus equity. This equation must balance at all times. It's what maintains that duality of transactions, which is, honestly, the absolute bedrock of double-entry bookkeeping. Moving right along to Section 2, mastering the T account logic and double-entry execution. So one of the biggest areas where students just throw away marks is confusing capital items with revenue items. Let's use a really simple analogy to permanently separate these concepts in your head. Imagine you're opening a brand new cafe. Buying the high-end espresso machine, that's a capital item. It's a long-term asset you're going to keep and use for years. But buying the coffee beans, that is a revenue item because it's a day-to-day running cost. So whenever you face a tricky transaction in the exam, just pause and ask yourself, wait, is this the machine or is this the beans? Now, our technical execution always has to follow a strict step-by-step procedural flow. Step 1, we identify the correct source document like an invoice or a bank statement. Step 2, we take that data and record it in the books of prime entry. And Step 3, we post it to and balance the T accounts. Those T accounts remain the absolute gold standard for visualizing double-entry logic clearly. And speaking of finalizing those T accounts, here is a critical detail. We have to master the difference between balance B/D, which is brought down, and balance C/D, which is carried down. The balance carried down is our closing figure. That figure then drops down to become the brought down balance to kick off the new period. Getting this exactly right is literally the only way to ensure 100% accuracy when we finally hit that trial balance phase. Now, what's really interesting about this is how they test it. Let's use our practice session to walk through a notoriously tricky question from the 2024 past papers. The examiners constantly tries to trip us up on calculating discount percentages when a scenario offers both trade and cash discounts. So what's the secret logic here to solve this? It's simple. Always deduct the trade discount first from the list price, period. Only after you do that do you apply the cash discount percentage to that new lower subtotal. If you accidentally apply both percentages to the original starting price, your T accounts will just never balance. All right, Section 3, the prudence concept pitfalls, dealing with adjustments and valuation. So, the prudence concept is an absolute cornerstone of accounting transparency. It basically dictates that potential losses must be recognized immediately, while potential gains are only recorded when they are actually realized. The core objective here? Making absolutely sure that profits are never, ever overstated. Because honestly, ignoring potential losses is a direct violation of this principle, and it is a massive red flag to any examiner marking your paper. So, how do we actually apply prudence in practice? Let's look at a couple of key adjustments. With depreciation, the prudent action is actively recording the loss of the asset's value over time. You have to account for that wear and tear. For inventory valuation, prudence dictates we value it at the lower of historical cost or net realizable value. Doing these adjustments properly is what maintains the total integrity of our final financial statements. And, prudence also heavily impacts how we view inter-firm comparisons. Just think about two identical clubs. One uses straight-line depreciation, so they're writing off the exact same amount every single year. The other club uses reducing balance, which means they are writing off far more in the early years. Because of these entirely different accounting policies, making a direct apples-to-apples comparison between their surface-level profits is incredibly difficult. We really have to look deeper to understand the true financial picture. Next up, Section 4, Evaluating Liquidity and Ratios, specifically for Assessment Objective 3. In the exam, we might be given a scenario and asked a really analytical question, like why did the club's current ratio suddenly drop? Now, this requires a total shift in our mindset. We have to move from doing basic math calculations to doing high-level evaluation. We essentially have to play financial detective. So the crucial point is understanding the severity of the numbers. Look at a drop like this, a current ratio plummeting from a very healthy 2.5 to 1 all the way down to a risky 1.1 to 1. This represents a severe liquidity crisis. The club is dangerously close to simply not being able to cover its short-term debts. To really secure those top marks in our AO3 written responses, we need to evaluate the exact causes of this drop. You need to ask, has the club overpurchased inventory that is now just sitting there unsold? Are trade payables being settled way too slowly, which damages our supplier relationships? Or, going back to our earlier cafe analogy, were cash reserves rapidly depleted because they just bought a super expensive new coffee machine, a massive capital expenditure? Detailing these exact causes proves to the examiner that we have a deep, practical understanding. But remember, our evaluation shouldn't just stop at the hard numbers. We also must consider the non-financial factors. Things like staff morale, the club's physical location, and its overall market reputation. These factors aren't captured anywhere in the T-account ledgers, sure, but they absolutely determine the real quality of the profit and the long-term sustainability of the whole organization. Moving on to Section 5, AI Accounting in Reality and Modern Financial Intelligence. I was actually reading this fascinating 2025 fintechs case study recently involving modern software platforms like Xero. These platforms are now using artificial intelligence to automate these exact double-entry accounting equations. But here's the really cool part. The AI only works because it's built on the exact same logic we are studying right now. The ALE equation, the concept of duality, the capital versus revenue rules. By mastering this syllabus, we're literally learning the underlying language of modern financial tech. And finally, Section 6, Examiner Do's and Don'ts, focusing on securing those final marks. Listen to this direct quote from the recent Principal Examiner reports. Students often lose marks through poor handwriting in ledger accounts and the failure to distinguish between revenue and capital items. Guys, this is the ultimate examiner warning for us. If they literally cannot read our balance CD because our handwriting is messy, they simply cannot give us the mark. It's that simple. So let's lock in this final checklist. First, do show all your workings. Method marks can totally save our grade, even if our final calculation is slightly off, as long as our logical flow is visible on the page. Next, do maintain legible handwriting. Also, do manage your exam time efficiently. Allocate your minutes based on the actual mark weightage of each question part. Do double-check state symbols if a manufacturing account pops up. And crucially, whatever you do, don't confuse capital and revenue items. Well, we've covered the mandatory modern terminology, the step-by-step T-account logic, the strict prudence rules, and exactly how to evaluate liquidity ratios like absolute professionals. So, the only question left is, are you ready to apply these elite strategies and secure your A star in 0452? Let's take this blueprint, apply it to those practice papers, and go dominate this exam.